There's something happening right now that most people are completely missing. Not because the information isn't out there, it absolutely is, but because it's being dressed up in the most boring, unsexy language imaginable. Market updates, infrastructure adjustments, compliance readiness, and everyone just scrolls past it. But what if I told you that underneath all that corporate jargon, there is a master plan unfolding, one that's been quietly assembling its pieces for years, and it leads to something so audacious, so genuinely historic, that when it finally clicks into place, the entire world will feel it. Stay with me, because by the end of this, you're either going to think I'm completely out of my mind, or you're going to wonder why nobody else is connecting these dots. Let's start with something that happened not too long ago. A sitting president stood up and said, almost casually, that the technical backbone of America's financial system is decades out of date. Decades. He said payments are slow, clearing takes days, sometimes weeks, and that the whole ancient structure is ready for a 21st century upgrade using cutting-edge crypto technology. Now, when the most powerful person on the planet starts using phrases like that in official addresses, you'd think that would be front-page news everywhere. But it wasn't. Most people heard it, shrugged, and moved on. That was your first clue. Because around the same time, and this is where it gets interesting, the New York Stock Exchange quietly announced plans to tokenize its securities. Then NASDAQ filed paperwork with the SEC to enable trading of tokenized stocks on its platform. Then word came out that U.S. Treasuries, the backbone of the global reserve system, are headed for tokenization too. And the DTCC, the institution that clears and settles literally trillions of dollars in transactions, announced it was preparing a soft launch with 50 institutional firms, one of which is already licensed and ready to plug directly into that infrastructure. Each of those, individually, sounds like a routine business update, a press release, a filing, something a compliance officer dreamed up over a Tuesday morning coffee. But pull back and look at all of it together, and a completely different picture emerges. This isn't a series of disconnected market adaptations. This is coordinated. This is choreographed. And if you follow the thread long enough, it leads to a single destination, one that a lot of people in this space have been quietly whispering about for years, but very few have had the courage to say out loud. Before we get into the deeper layers of this, let's acknowledge the legislative piece because everything else depends on it. The Genius Act, which was passed in the summer of 2025 to bring America into the digital payments era, created the first formal framework for a reserve digital dollar, backed dollar for dollar by short-term U.S. Treasury securities. That's not a small thing. That's a structural shift in how America thinks about money. And now the Clarity Act is next, the market structure bill that will finish what the Genius Act started. People said the Genius Act would never pass on time. Analysts predicted delays stretching into 2027. They were wrong. And right now, the same voices are casting doubt on the Clarity Act, saying it won't move fast enough, that the calendar is too tight, that the political will isn't there. But here's what those voices are forgetting. The political incentives are perfectly aligned. Nobody heading into a midterm election wants to be the reason America fell behind on crypto. Nobody wants to campaign with that hanging over them. The window before August recess is real. The urgency is real. And the people who actually authored this legislation are saying, on record, that before the end of July is a legitimate target. I believe them. Not blindly. I believe them because the pattern of the last 2 years shows that when there's this much institutional momentum behind something, the political machinery tends to find a way. Now here's where we have to go deeper. Because the legislation is just the scaffolding. What's being built on top of it is something far more significant. Think about why all of this tokenization is happening right now. Not 5 years ago, not 10 years ago. Why now? Partly because the technology finally exists at the scale required. The infrastructure that was being developed in the background, tested, refined, and dismissed by mainstream finance for years, is now mature enough to handle what's coming next. But there's a more urgent reason. The United States is carrying a debt load that is genuinely unsustainable under the current system. The Petrodollar arrangement, where global oil is priced and settled in US dollars, giving the dollar its dominant reserve status, is showing real cracks. That arrangement now accounts for roughly 80% of global oil transactions, down from near total dominance not long ago. The world is quietly, slowly decoupling. So the question isn't whether the US dollar needs a new foundation. It absolutely does. The question is what that foundation looks like. Here's the theory, and I want you to really think about this. Congress passed a ban on central bank digital currencies that runs through 2030. not a permanent ban, a temporary one. Why would you set an expiration date on something you fundamentally oppose? You wouldn't. You'd set a timeline if you were building towards something and needed the runway to get there first. What if that runway is being used to tokenize the entire traditional financial system? Equities, treasuries, corporate bonds, municipal bonds, real assets, every instrument of value, and migrate that liquidity onto Ledger. What if, by 2030, the architecture is complete enough that you can revisit the CBDC question from a position of total readiness rather than improvisation? And what would back that digital currency? Not gold, which was abandoned, not oil, which is slipping, something far more comprehensive. Reserves drawn from every tokenized sector of the economy, sitting on chain, transparent, verifiable, and immovable without a record. A US dollar backed not by a single commodity or a bilateral arrangement with energy producers, but by the full economic output of the most powerful nation in human history, all of it on Ledger. That dollar would be, without exaggeration, the most secure reserve currency ever created. Now think about which protocol is already embedded in the settlement infrastructure of the institutions building this. Think about which company just acquired a prime brokerage and is already licensed to operate within the DTCC's clearing architecture. Think about which ledger has been quietly running at scale, handling cross-border value transfer at fractions of a cent per transaction for years. And then listen to what one of the most senior infrastructure builders in this space said publicly, without hesitation. Custody, payments, stablecoins, tokenization, prime brokerage, treasury management, all packaged up and ready to deploy for banks and financial institutions building their digital asset strategy on top of it. That's not a startup pitch. That's a company describing a complete, end-to-end operating system for the next generation of global finance. Already built, already licensed, already waiting. What you're watching, if you look past the press releases and the jargon and the deliberately boring headlines, is the final stages of a setup that has been years in the making. The regulatory framework is coming into place. The institutional players have already committed. The infrastructure is plugged in and ready to go live. And the academic and policy voices who would have laughed at this conversation 5 years ago are now saying on camera, in front of audiences at the Federal Reserve, that a Ripple-like protocol could very well be the clearing layer for the dollar of the future. One of them even chuckled nervously when it came up, because when an idea goes from fringe theory to something that a St. Louis Fed researcher floats in an official context, you're not dealing with speculation anymore. You're dealing with a scenario that serious people are taking seriously. So when I look at everything together, the legislative push, the institutional migration to tokenization, the DTCC's soft launch, the national bank charter application, the infrastructure already in place, I don't see a series of market updates. I see a blueprint that's been rolled out in plain sight, piece by piece, in a language most people don't speak fluently enough to recognize. The trap, if you want to call it that, isn't being sprung suddenly. It's been closing slowly, deliberately, and almost invisibly. And by the time the broader world realizes what happened, the architecture will be complete, the legal framework will be in place, and the switch will simply be waiting to be flipped. The most important asset in the next era of global finance might not be something you can hold in your hand. It might be the protocol that settles every transaction in the new digital economy, the invisible rail that every bank, every institution, and eventually every government runs on. The pieces are on the board, the players are in position, and the clock is moving. If this opened your eyes to something you hadn't considered before, the best thing you can do right now is share this with someone who needs to hear it. Drop a comment below telling me where you think this is headed. I read every single one. And if you haven't subscribed yet, do it now, because the next video connects threads that make this one look like the introduction. You don't want to miss it.